Welcome to the pit. I'm Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors. Now let's get into today's numbers. Here is the forensic math of living until age 95. Most Singaporeans turning 55 this year will leave over 60,000 Singapore dollars in compounding purchasing power on the table by simply defaulting to the standard payout structure. Not because they made a bad investment, not because the market crashed, because they never calculated their personal crossover age. And that one missing calculation is structurally guaranteeing a permanent erosion of their lifestyle by their 80th birthday. Today, I'm going to show you exactly where that $60,000 goes. I am going to show you the mathematical break-even point between the CPF Life Standard Plan and the Escalating Plan. And I am going to show you how to position your CPF and SRS architecture to outlive your baseline expenses all the way to age 95, which current Singapore health data tells us is a statistical probability, not a miracle. The math is there if you choose to see it. Let us begin. Before we look at the plans themselves, we have to understand the market environment we are operating in right now. The 6-month SGST bill closing bid yield sits at approximately 1.4% per annum as of early April 2026. Meanwhile, your special account continues to pay a guaranteed base rate of 4.0% per annum for the second quarter of this year. That is a 260 basis point spread. 260 basis points of pure guaranteed structural advantage over the risk-free alternative. This spread is the foundation on which your entire retirement capital base is built. Keep that number in your head. We will come back to it. Stage 1, the compounding window, age 30 to 54. If you are in this window right now, your special account is the primary engine of your retirement architecture. The guaranteed 4.0% floor is not just a number, it is a sanctuary. In a global context, this risk-free yield vastly outperforms the fixed income allocations of pension schemes in the United Kingdom or Australia, which have to take on significant duration risk to chase similar returns. If global interest rates were to collapse by 10% over the next decade, a full macro recession scenario, this policy floor mathematically shields your retirement baseline from that volatility. What does this mean in dollar terms? For a 40-year-old heartland earner with $120,000 in their special account, this mechanism guarantees $4,800 of annual compound interest, entirely immune to the volatility of the Straits Times Index. Every single year, regardless of what the market does, regardless of what the Fed does, regardless of what the property market does, think of your special account like an HDB-linked upgrading program. It is slow, it is highly structured, it is entirely outside your daily control, but it guarantees that the value of your property is elevated permanently. Voluntary top-ups during this window act as an accelerant. Now here is the critical question. Should you take money out of this system to chase higher yields in the private market? Let us do the forensic math. My minimum yield hurdle for any external asset is 4.7%. That is the Iggy forensic floor of 3.2% plus 150 basis points of mandatory risk premium. If your private portfolio cannot consistently clear 4.7% across a full market cycle, you are abandoning a guaranteed structural floor to chase an uncertain one. The forensic picture is clear. Max out your CPF limit first. Now let us look at a specific dollar consequence. If you have $220,000, the full retirement sum sitting in your retirement account at 4% versus sitting in your ordinary account at 2.5%, that 150 basis point difference compounds to over $33,000 over 10 years. This is not theoretical. This is arithmetic. And it is exactly the kind of silent wealth destruction that our 45 to 65-year-old heartland audience cannot afford to ignore. Stage 2. The pivot point, age 55 to 64. At age 55, the structural rules of the game change overnight. Your ordinary account and special account balances are swept to form your retirement account. But here is the mechanic that most people miss entirely. The special account no longer exists as a separate account after this point. It is closed. Historically, savvy retail investors use the SA shielding loophole, manually parking OA funds into high-yield instruments, forcing the RA to draw from the lower-yielding OA. That door has been permanently closed. For members turning 55 in 2026, the retirement sum tiers are as follows. The basic retirement sum stands at $110,200. The full retirement sum is $220,400. And the enhanced retirement sum, the tier that changes everything, is $440,800. In 2026, the ERS happens to be exactly 4 times the BRS. If you fully fund the enhanced retirement sum, you secure a permanent uplift in your baseline monthly payout at age 65. You also mathematically reduce your dependence on volatile SGX dividend income during your drawdown years. That is the forensic case for topping to ERS. But here is the uncomfortable truth that many heartland investors ignore. Many people in this decade focus entirely on their CPF balance and completely forget about their SRS. and that is financial sabotage. When you reach the statutory retirement age, you can withdraw from your supplemental retirement scheme over 10 years, with 50% of the withdrawal being entirely tax-exempt. The annual SRS contribution cap for Singapore citizens and PRs stands at $15,300. This is Kopitiam logic. If the uncle at the drink stall offers you a 50% discount on your daily kopi for 10 years, you do not reject it because the paperwork is tedious. You take the discount every single year, without fail. If you have been maxing out your SRS at $15,300 annually for 10 years, that is $153,000 in contributions before any interest or returns. The 50% tax exemption on withdrawal turns that pool into a structurally tax-efficient income stream that most heartland investors are simply leaving on the table. Stage 3. The drawdown architecture. Age 65 and beyond. This is the architectural core of your retirement. And this is where the forensic math of living until age 95 becomes brutally clear. When you turn 65, you face the central decision: CPF Life Standard Plan or CPF Life Escalating Plan. The standard plan gives you a high starting payout, but it offers zero inflation hedge. If inflation averages 3% annually, the purchasing power of a fixed $1,000 payout drops to roughly $600 by your 85th birthday. You started with $1,000. 20 years later, in real terms, you have $600. That is a 40% purchasing power destruction, while your medical bills are going in the opposite direction. The escalating plan starts its payout approximately 20% lower, but it grows by 2% compounded every single year. This is a confirmed CPF feature, not an estimate. So the question becomes, at what age does the escalating plan overtake the standard plan in total cumulative cash received? Let me walk you through the math. Say the standard plan pays you $3,440 a month from age 65. The escalating plan starts you at approximately $2,750. That is a starting shortfall of $690 per month. But every year, your escalating payout grows by 2%. By age 70, it reaches approximately $3,030. By age 75, approximately $3,350. By age 80, it has reached approximately $3,700, now higher than the standard plan's flat payout in real dollar terms. And by age 85, you are receiving approximately $4,080 monthly, while the standard plan investor is still receiving $3,440. That is the crossover. Actuarial analyses place the cumulative break-even, where total cash received on the escalating plan surpasses total cash received on the standard plan, somewhere between age 78 and 82. It is not official CPF data, it is an actuarial estimate that varies by gender and cohort. But the direction is unambiguous. Current Singapore health data confirms that reaching age 95 is a statistical probability. When medical inflation peaks in your 90s, the flat payout of the standard plan will systematically fail to cover your out-of-pocket expenses. The escalating plan is not just a better financial product, it is longevity insurance built into the structure of your retirement income. So what does this mean for you? You need to look at your SN score, your Sanctuary Asset Necessity score. Does your combined income floor CPF Life payout plus SRS drawdown plus SGX dividend yield actually clear your monthly expense baseline? If the combined total is $3,500 and your baseline expenses are $4,000, you have a $500 forensic gap. That gap must be bridged by your equity portfolio with all the market volatility that comes with it. The SAN score tells you how exposed you really are. Many investors see the escalating plan's lower starting payout and immediately reject it. This is the wet market lobang fallacy. You see a cheaper cut of meat today and ignore the fact that you will be charged double for the same cut next year. The escalating plan strips away the psychological comfort of having more cash at age 65, forcing a delay in gratification to ensure you are not mathematically destitute at age 90. The single costliest retirement decision most heartland investors make is assuming the CPF Life Standard Plan is the default safe choice. It is not. You are trading long-term purchasing power for short-term psychological comfort. By selecting the highest initial payout at age 65, you are structurally shorting your own lifespan against medical inflation. If you live past age 82, every subsequent year on the standard plan represents a negative real yield consequence on your daily expenses. You are effectively paying a premium to feel wealthy in your 60s while guaranteeing systemic cash flow pressure in your 80s. Inflation does not respect your fixed payout. The math is brutal, and longevity is the silent margin call on a flat yield retirement portfolio. Now I want to show you how all of this plays out in practice. The Marine Parade household, 58 years old, semi-retired. His ordinary account balance is $180,000. He has been maxing out his SRS at $15,300 annually for a decade. leaving that account at $180,000. Outside the CPF system, he holds 3 SGX blue-chip REITs yielding an average of 5.2%. He is electing for the CPF Life Escalating Plan at the Enhanced Retirement Sum tier. Here is the 5-layer forensic audit of his income at age 65. The standard plan at ERS of $440,800 would pay him approximately $3,440 a month. He chooses the escalating plan. It starts lower at approximately $2,750 per month, but it will grow by 2% every year for life. By age 75, that opening payout will have grown to approximately $3,350. By age 80, approximately $3,700. He is not taking less. He is deferring the upside to the years when he will need it most. His 10-year SRS drawdown provides $1,500 monthly. His SGX dividend portfolio of $200,000 at 5.2% generates $866 monthly. That 5.2% clears my 4.7% forensic yield hurdle. It passes the test. Total projected monthly income, $5,116. Against his estimated monthly expenses of $3,800, he carries a surplus of $1,316. His SN score, pass. Now here is the second order consequence most people miss entirely. Many retirees justify the standard plan by claiming they will aggressively reinvest the higher initial cash flow and generate their own synthetic yield. The forensic reality is entirely different. Without an automated structure restricting access, that surplus liquidity is almost always absorbed by lifestyle creep, medical shocks, or family obligations. The escalating plan forces structural discipline. It ring-fences your future inflation protection at the source, preventing you from consuming tomorrow's healthcare budget to fund today's holiday. When you rely solely on your own discipline to beat actuarial tables over a 3-decade horizon, you are taking a risk you cannot afford to take. One final note on my stress test buffer. When I project SGX dividend income against guaranteed CPF rates, I apply a conservative floor of 3.2%. While the current T-bill rate sits at approximately 1.4%, I do not lower my personal standards to match a temporary market low. My floor is 3.2%. My minimum yield hurdle for any SGX holding is 4.7%. We plan for the storm, not just the sunny day. Stage 4. The legacy layer. CPF savings are excluded from your will. They do not form part of your estate. This ring-fencing mechanism was designed to protect retirement funds from creditors, but it creates a specific risk that most heartland investors completely overlook. If you pass away without a valid CPF nomination, your funds are handed to the Public Trustee's Office for distribution under the Intestate Succession Act. They deduct administrative fees. The legal process can take months. For a $300,000 residual account balance, the cost in administrative fees and the opportunity loss of that capital sitting uninvested during a protracted legal handover can run to several thousands of dollars. Make your CPF nomination. Update it the moment your marital status changes. Marriage automatically revokes your existing nomination. This is a 5-minute action that protects decades of accumulated capital. Do not defer it. As you look at your own numbers, 3 strategic considerations. First, if you are between 55 and 64, calculate the precise dollar difference required to upgrade from the full retirement sum to the enhanced retirement sum before your payout starts. The gap is $220,400. Forensic modeling indicates that topping to ERS has historically produced materially higher baseline payouts. Verify the current figures at the CPF portal before you commit. These numbers increment annually. Second, model your crossover age. Request payout estimates for both the standard and escalating plans directly via the CPF Life payout estimator. Knowing that the actuarial break-even typically falls between age 78 and 82 allows you to measure the cost of your longevity risk in plain dollar terms. Third, audit your SGX dividend portfolio right now. Every holding must clear the 4.7% absolute minimum yield hurdle. Any asset yielding below this threshold fails the risk premium test and should be restructured into sanctuary assets before your drawdown begins. Will your current retirement income architecture mathematically survive your 90th birthday? Or are you secretly relying on hope as a strategy? The forensic math of living until age 95 is not complicated. It is uncomfortable, and it is available to anyone willing to do the calculation. All CPF figures quoted today, including the retirement sums, payout estimates, and SRS contribution caps, are subject to change. Always verify the current numbers directly at cpf.gov.sg before making any decision. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.